This is Josiah from Hedge It Forward, where I will show you a macro view of the economy before diving into technical analysis. We'll build out our thesis for the week, and then we'll see where the opportunities are and how we are trading it. So with that, let's jump in. All right, so taking a look at rates for the week, mortgages actually creeped up just a little bit, even though the Fed cut rates. That means the yield curve is actually steepening. 10-year went up, and that's mainly because of the debt problem that we have in the background. But overall, taking a look at all the rates across the curve, you've got the 10-year that went up slightly. You've got the 30-year that went up. So on the long end of the curve, we're seeing a rise. On the front end of the curve, we're seeing a drop. And that's noted here with the Fed funds futures for 2026. Looking at the bills, you saw a big drop in the 2-year, and then the 30-year and that long end of the curve, we actually saw the increase. Take a look at this. So I've drawn out here where the terminal rate for 2026 is. So we just had a rate cut, and we don't know exactly when they're going to be doing another rate cut. There are actually futures for roughly every month for next year. But I'm only going to be looking at where is it going to end in December of next year. So I'll call that the terminal rate. Here is where it's priced. I've drawn out 2 cuts, 3 cuts, and 1 cut. Looking at where it's priced in, the market thinks next year, at the end of next year, there's only going to be 2 cuts. We just got one the other day. It thinks 2 more cuts. The Fed actually thinks 1 cut. They all voted on that for the December Summary of Economic Projections. They only showed 1 cut. That's what the Fed is thinking. But remember, Jerome Powell steps out in May, and Trump is going to find somebody that's aligned with him, which will probably be 2 to 3 cuts, maybe even more. Given the employment situation is okay right now, this is why the market's pricing this in. So you can see where I have this red line drawn. This is the FOMC meeting day. And just prior to that, we were actually going down to 1 cut instead of 2. And then it reversed. And you can see when it was announced, no real change. It stayed pretty flat. That's 2 or 3 basis points right here. We'll keep an eye on this. I do think it's going to be leaning more towards the 3 cuts. I do have a position in this. And once we start pricing in 2.5 to 3 cuts for December next year, I'll probably close that. This is the same view. Let me draw this out real quick. It is the FedWatch tool. And you can go Google FedWatch tool, and this will come up. And this is where the futures are priced. You can see ZQZ, which is December of 2026, 96.89. And that, through all of these futures calculations, mathematically, where the probabilities are on rate cuts. What I'm pricing in particularly is December 9th, 2026. And you can see that there is a 32% chance of 2 cuts and a 23% chance of only 1. And that is all based on how the future is priced. So that said, let's take a look at the summary of economic projections, because this is what came out on Wednesday. This was the high risk event day that I was talking about last week. So just look at some of the changes in September. They had priced in, not really priced in, but they had put their projections for GDP to be 1.8, increase to 2.3. So they're expecting a little bit stronger growth. Unemployment staying flat for the year. I don't know where that's going to land. I see that weakening a little bit more because we've had a lot of layoffs in the last few months. Some of the highest layoffs we've actually seen. So I think that might be a little bit light. But they have about 300 PhDs, and there's just me. PCE inflation, look at that. They're expecting this to actually come down to 2.4. I agree with that. Their September projection was 2.6, and I do believe that they're going to be closer to this as the tariffs don't have the impact that everybody thought they would. And with housing coming down, I think that's going to help your inflation overall. And core PCE still 2.5. But here's what they're thinking, 3.4 on that Fed funds rate. No change from what they said, but that really only represents 1 cut. We're at 3.625 now, 3.4, which would be 3.375. That's 1 cut. Let's take a look at how they voted. All right, so take a look at where we are right now. This is the Fed funds rate where it was before the FOMC meeting. Most people voted to drop at 1. And you can see that here. Most people were in this category. You had a few people up here that thought, no cut. It's interesting. They must have sent this survey out prior to the meeting, and people were penciling in no cut. And this shows that there were 6. But when you get down here to the minutes, the actual day, you have Goolsby and Schmid that said, nah, let's keep it the same. You had Myron, who said, I want a 50 basis point cut. Remember, Trump just put him in not that long ago. But overall, this is where they decided to keep the rate. So they just did 1 cut. And then take a look at the end of next year. This is the piece this is ZQZ 2026, which I'm trading. You got this guy down here says we should go down by, what, 6 cuts? And everybody else is kind of like, oh, you know what? I think it should be somewhere in this range. So when you compare all of this comes out to that 3.4 mark. So that's where everybody says that the rates should be, but you definitely have a wide dispersion of dissenters. Interesting. We'll see where it ends up. This is why, again, I think Trump's going to put somebody else. Maybe it's Hassett, maybe it's Bessent. Any one of those, Hassett, Bessent, Reader, they're all wanting rate cuts. So I think you'll see that drop down. So Myron's belief is rates do this. You can see exactly what camp he's in. Okay, so that's where the rates are. And then you've got everybody else that says, no, this is what the curve should look like, something more like this, and settle at around 3. That's where everybody thinks the neutral rate's going to be. All right, so looking at the rest of the curve, you've got the 1 month. So this is fascinating. Fed ends QT, they announced it October 31st, and you can see on 12/1, they really started buying $40 billion a month worth of treasuries, and this is definitely having an impact. Look at that, 4% a couple of weeks ago, down to 367. That's a huge move on the 1 month. Look at the 2-year. This has performed very well over the last couple of years, so bond prices are actually rising on the 2-year, plus you're getting a decent rate. 2 years actually outperformed the 10, even though the 10 paid a higher rate, just because of the increase in the bond prices. So that today is paying 3.52, and then the 30-year pulled back a little bit, and now that is paying 484. I actually went out and bought some bonds on the 20-year, so I added a little bit of duration. So I went and bought some bonds that are paying a 487 for the next 20 years. I'll take it. And if the rates fall, the bond prices will increase. So not only will I get that 487 for the next 20 years, I will get the capital appreciation as well, because bonds will rise as yields fall. Now, take a look at the option adjusted spreads. We looked at this last week. You got your AAA paying about 33 basis points above the risk-free rate. So that's not very much, but those are your top cream of the crop companies and what they're paying on their debt, just 30 basis points above the risk-free rate. So think of the 10-year paying around 418. This would be paying around 450. Investment grade, 80 basis points, not much here, no change from last week. Triple B, 100 basis points above. High yield, 288 basis points above. Then you got triple C, which are your junk bonds, paying 900 basis points almost, and still falling. Nothing to see here. It's still falling. So that means it's getting tighter on the spreads. The 10 years going up a little bit. That's just saying is there's nobody even worried about debt at all or default risk. Now, when I talk about these different rates, let me show you something from Fidelity. I want to show you, because I'm always talking about rates. What does this mean? What does this mean? As an investor, we can go out and buy those rates depending on what bonds we're interested in. Do we want a risk-free rate? Do we want a little bit more yield, but we're taking on some default risk? So just going out to Fidelity, I won't spend a lot of time on this. I'll just show you just a couple quick things. Here's the treasuries. You can see across the curve, there's the 3-month. We looked at the 1-year a minute ago, 358. There's the 10-year, 418, the 20-year, 487.50, the 30 years, 485. You can go out and buy these and get 488. You can go out and buy corporates. Here's some corporate bonds we were talking about a minute ago. Those are paying 30 to 80 basis points above the treasury. And look, the 10-year, they're at 454, whereas the 10 years are around 418. So those are just some averages. And then here's some bonds down here, the triple Bs, 618 on average, and then we'll get shorter duration. Some of these will have different optionality to it, so you may get a little bit more yield. The other one is just an average, and then you get into some municipal and taxable facilities. So when I'm showing these rates, it's what you can buy. Debt is higher in the capital structure than equities. These are less of a risk than equities. And with equities, you have the risk that equities can fall, whereas this is just going to pay a straight up coupon, and you'll get that coupon unless the company defaults. And when a company defaults, the bond payers get paid first, and then the equity holders are left holding the bag. That's why equity, you want to expect a little bit more return. But you also have to take the risk that the stock could fall. So, looking at the Fed Reserve balance sheet, this was fascinating. I mentioned this last week that money was getting tight. We talked about the standing repo facility and liquidity becoming a problem. Well, they talked about it, and they are basically entering QE again, which is quantitative easing. The only difference between this And real quantitative easing is where they went and buy all the mortgage-backed securities and longer dated bonds. They're not doing that, but they're still injecting $40 billion into the economy through buying T-bills, and they're going to do $40 billion a month. We talked about this line here, this white line here is all your bank reserves. We knew it was getting tight because banks are having to go to the standing repo facility. If you look at this line here, this represents SOFR balances. So you have your secured overnight financing rate, which is everybody borrowing from each other. And you can see that their balances are north of 3 trillion, roughly 3.3 trillion. And every one of these little spikes here, you can see that this top line here, the price of money actually goes up because these banks are running lower and lower on cash, and they're going to have to charge more to lend that cash to each other. The Fed steps in and says, hey, I've got this standing repo facility, and we're going to cap that rate. This is how they cap this top line here. That's the rate there, and that's how they prevent the banks from driving the cost of money up. The standing repo facility is here to say, hey, rather than borrow from another bank, go borrow from me, the Fed. Anywho, we saw this last week. The Fed mentioned it this week. And here is on December 10th. They said, we are going to now start buying $40 billion worth of T-bills. Here, they're injecting it because banks have to borrow it. Here, the Fed's just saying, I'm putting $40 billion of cash into the bank system. Some people will call it they're printing money. But they're going to be buying treasuries. They're going to be growing their balance sheet again. Not a good thing. They were trying to run it off. Well, they're at $6 trillion now. It's not going any lower. They will be growing their balance sheet. And this is also kind of like a Fed put, where the Fed's saying, hey, I'm going to step in, and worst case scenario, I'm going to inject liquidity into the system. So that's problematic. Now, you're going to see the Fed balance sheet grow, but in return, you're also going to see bank reserves start creeping back up. They did this preemptively because between January and April is tax season. So they know if people are paying tons of taxes, money is going to come out of this section here, which is all your banks. Money is going to come out of the banking system, and it's going to go to the government. You'll see that, watch, in a couple of months. I'll go through it again. Then you'll see bank reserves starting to come down. You'll see this TJ account go up because this is the IRS. This is the Treasury account. So that said, they were preemptive and they started buying it on December 11th. $40 billion got injected into the system, and that's going to start increasing these balances. Preemptively, January, February, this should all increase, and then in that time frame, you'll start seeing that run down because they do not want to see it hit ample reserves. That would cause a bigger macro problem, and then you'll see the TJ account start going back up. So, all that said, an interesting thing that we saw this in the last few weeks with injections of a liquidity. Keep an eye on this. I will report on this from time to time because if that $40 billion does not work and it's not enough and money continues to drop out of the banking system, you'll see this start having some clogs again. And if that happens, you're going to have a bigger macro problem. Is there an immediate problem today? No. But it is something worth watching. Jumping into the market, let's take a look. Earnings this week, we dropped the last quarter. This is forward 4 quarters. So remember, we were in that 295 mark. Now we're up to 303. That's because we took the next quarter at the end of next year and we brought that forward. So that's why that's 303. So we have rising earnings, but based on the current price, we have a 22.4 PE ratio. That's a little bit high, but not that bad. We were pretty flat throughout the week, and then Friday we did have a little bit of a hiccup. That meant volatility went up, and that's good for me as an options seller. Couple things to note here is this line here. Keep an eye on that. That's around that 675, 60. If you're watching SPY, it's 675. If you're watching SPX, it's going to be 67.50. This line here is going to represent your first level of support. If it pulls back on Monday or Tuesday, expect it to bounce, but if it doesn't hold and it falls, it's going to fall back to roughly this line here, that 6,500 mark. That was the big support we saw from a few weeks ago. Looking at our performance for the week, you can see we had a decline about 0.63, so not a big decline, but that was driven mainly by the Mag 7, the Magnificent 7. And you can tell that based on the S&P equal weight. Actually, the equal weight went up. So more of the troops are increasing, but the Mag 7, who have a big weighting in the stock market, actually pulled the stock market down. And that's because the AI trade is back in where there's a belief that it's an AI bubble with Oracle earnings that did not help Broadcom. they all pulled back, and that's definitely dragging the market down. That's what happened on Friday. But equal weight, the troops are feeling good. Then IWM, so that's your small cap stocks, definitely doing well, 1.23. However, they are looking to be a little bit overbought. TLT, so your 20 or 30 year bonds we talked about on the long end of the curve, that's actually going up, which caused TLT to go down. So this may be an opportunity. I'm adding duration, so I think TLT is a buy. I also think that ZBZ, ZBH, which is your 20 and 30 year bonds on the futures market, either one of those I think are a buy. And then your home builders, 0.44, so a little bit of an increase. And then AGNC, my favorite, is down 3%, but it's still a little high, and I think there's going to be some pullback on that one. And then live cattle, we'll get into towards the end, where live cattle actually had an increase. So there may be another short opportunity coming up. We'll get into that here in a minute. Looking at some of the technicals, our put-call ratio remains on a buy signal. You can see that definitely rolled over. So that means SPX, according to put call, is a buy. People are getting less fearful. This represents where people were the most scared. They're still scared, but not as much. That is an indicator to buy. Look at your new highs and new lows. Definitely printing some new highs. This shows there's a lot of stocks underneath the surface, mainly the smaller ones that are printing new highs. So the troops are feeling it. They're doing well, but it's the generals, the big Mag 7 that aren't feeling so well. So underneath, it's a better story. Market breadth is improving. MACD is still on a buy signal. Another indicator of market breadth are stocks above the 50-day and the 200-day moving average increase. So market breadth is definitely improving. Again, it's the Mag 7 that's pulling it down. VIX is showing a buy signal, still on a buy signal. We did have a little bit of volatility, which I ended up selling at this point here. Volatility spiked because of Oracle, Broadcom, and the tech. Started bringing it down, and it fell like 1.5% on Friday, which caused volatility to spike, but then it looks like it came back down, so that's actually a positive. So overall, where we're at now is we're in this range. I could see it definitely going up to the 7,000, given all the indicators that are still bullish, unless the Mag 7 and that AI thesis takes over, that there's an AI bubble. I would expect this to continue to climb through the rest of the year. We are in a very strong seasonal trend of an increase. So I think that's going to be positive. Again, I don't like to predict. I like to sell volatility. So that means I'm selling 20 deltas a month out and on the overall market. So we'll see. As long as it stays within a range, then I'll be profitable, and then I'll roll it up or down. All right, so taking a look at what's coming up this week. If you're into housing stocks, we've got some information that's going to be reported on Tuesday. Wednesday, we get retail sales. I expect this one to be pretty positive. And then we get inflation report Thursday morning. This may or may not move the markets. I'm not sure how the market's going to interpret that because the government shut down. I don't know what kind of data got collected. So we'll see. The other big one that I've just passed over was on Tuesday, we get non-farm payrolls. Now, one of the things that Powell said in the Fed conference the other day is he believes that the unemployment number is overstated by about 60,000. So when you look at the jobs added, drop off 60K because there's some errors in the way it's counted. That means we may or may not have job growth. He also indicated that because of the way the sampling is being done this last month, I mentioned this about a month ago, don't put a lot of stock into this report. I have a feeling there's going to be the margin of error is going to be very wide. So I don't know that it's going to move markets much. It's going to be the first indicator from the government standpoint. We've been relying on ADP. With this one, I'm not going to put a lot of weight on it, but I can't tell you what the market's going to do. So watch that number. That'll be Tuesday at 7:30 in the morning Central Time. We'll see how the market digests that. Not sure. So last week I mentioned earnings crush and some companies that I was going to report on. I ended up doing pretty well on most of them. Campbell Soup I did well on, Academy Sports and Outdoors, GameStop, Chewy. You can see the returns that I made overnight. And Restoration Hardware, Costco. The two I did not do so well on is Wednesday. I placed a trade on Oracle, ended up losing 67% on that one. And if I didn't have enough of a beating, how about let's go into Friday with Broadcom. Let me do another AI thesis stock and end up taking a beating on that one as well, 71% on that one. I'm still working my way out of Broadcom, but again, if it goes down, again, I don't care how far it goes down because eventually it's going to retrace. Analysts increase their buy rating on Broadcom, so I still think it's a good play. I'm going to be working my way out of that one, and eventually I will be at my break even. So all in, it was a very profitable week because all of the ones that did well did very well. And then I had two that I took a beating on, and I'll just work my way out of those. There's solid companies. They're not going anywhere anytime soon. So I can definitely work my way out of it. So coming up this week from an earnings crush, there are several companies I will be looking at and potentially playing. I don't know until I get there because I've got to look at the volatility. I'm selling volatility, so I'm not taking a directional bet. I'm only working on the mispricing of options. So for this week, we've got Lennar, we've got General Mills, we've got Micron. I'm not sure if I'll play that one. If I do play it, I'll play it small because it is a tech company, and with the AI trade, may be a risk, higher risk than some of the others. I got CarMax, Darden Restaurants, FedEx, and Nike. I will be looking for options mispricing on these companies, and then I will be selling some options. Carnival and Paychex probably be what I look at on Friday. So those will be the companies. I'll report back next week on the ones that I did, and we'll see how they perform. No put sales this week because next week is Christmas and no companies are just small ones. I'm not going to trade any of these. No put sales for the week. And then the other trade that I will be keeping an eye on is my adjusted Bollinger Band indicator. I will be entering some trades on companies that have been overbought. So for example, on this recent sell, let's go scan. Here's some companies to take a look at. I actually had a position in Applied Materials. So here we are. There's the sell signal that my indicator highlighted, and I did enter a position on that. I will be keeping an eye on some of these other ones. I have a position in Blackstone, Cummins, GE Vernova, Hewlett Packard, On Semiconductor, a lot of these, Teradyne. A lot of these I went ahead and entered some positions on. So here, if you're interested in this indicator, let me know. Send me a note in the comments or send me an email, but it does give you buy signals and sell signals, and you can filter on those. Taking a quick look at the buy signals. There are the companies that are on the buy signals. I have not entered any of these positions. Mainly the options pricing wasn't there for me. But again, if you're interested in this, please let me know. Taking a look at IWM, this has been a favorite. This is small caps. Talked about this one probably about every week. We had a buy signal back here, and it shot up 10% since mid-November. Huge run up. This has caused the indicator to highlight a sell signal. So probably Monday, I'll see where it's at, and then I'm going to be selling calls up in this range. I will sell call spreads. I will not sell naked calls, but I will sell some call spreads on this to take advantage of the negativity that looks to be building. Now, what that'll do is it'll give me a little bit of wiggle room. So if the stock kind of teeters in this range, no harm, no foul. If it goes up, then I'm taking the risk. But I do not want to buy puts because I believe small caps are going to be doing very well. And I don't expect the market to move a ton. And I will make sure when I look at the expected move, I will price it above the expected move for the week so that I can just collect that premium. If I'm wrong and the market goes way up very quickly in a week, then I'm going to lose whatever the difference is within that spread. So it's the same thing that I was doing down here when I was selling these puts. I was selling put spreads down in this range. Now I'm going to be selling call spreads because I'm taking the opposite belief, but not for long. And then finally, I haven't talked about this in a minute, but live cattle prices. I mentioned this back in this range that there was going to be a giant short opportunity. And take a look at that. It fell from 245, 250 down to 204, 205 range. What a massive short. The good news is cattle prices started coming back. I guess it depends how you look at it. Steak prices are getting more expensive. Brisket's more expensive. Cattle for farmers is more expensive. The price per pound going from 205 up to 230 a pound, so another 20 cents a pound in less than 2 weeks. We're going to keep an eye on this one because if the price actually continues to climb, it's going to present another short, and I will take a position on that. Here's what happened. You see this red line here? Check this out. Screwworm.gov. They just opened up this website. This is problematic. We know it's problematic. The screwworm issue is a big deal to farmers. It's not in the United States yet, but it will be. But they opened up this website and they highlighted their responses. Well, they opened up a facility in Tampico. They opened up that facility in mid-November. So this is the facility right here. And they opened that on about November 13th. People probably knew that. The people who were in the business probably knew that. And that's what drove these prices down, because that facility is going to be able to release 100 million sterile flies into the population of flies. And that's going to help. Remember, they need 600 million of these flies a week to be dispersed in order to kill the screwworm and to push it back below Mexico. This map here shows all the different cases. They go to screwworm.gov, and these shows all the cases, where the facilities are. This guy here, this is the one I mentioned before with the Moore Air Force Base. This is probably going to do, I think, 200 or 300 million flies. This one's doing 100 million. You've got a couple of facilities down here. They're not listed, it looks like. But there's the existing facility and another facility that the USDA is helping with. And together, all of these facilities will produce 600 million flies a week, between 5 and 600 million. So that said, I expect that the prices will drop. Now, they're going to go up a little bit, especially if you get a report. Look how close these cases are. There's 3 cases in Nuevo Leon. And once that crosses the border, cattle prices are going to go up because there'll be a lot of news about it, and cattle prices will go high. But as these facilities start coming online, that'll drive the cattle prices lower. So keep an eye on this website. They're going to be posting news articles and things like that. So this would be the thing to watch if you want to play the cattle trade. I do think there's going to be an opportunity. I don't know where it's going to go from here. If it starts to retreat, I may buy a couple of puts. But if it keeps going up higher and it gets back into that 250 range, I will wait until I get a signal, and then I will be going long, or I should say short, and I'll be buying puts. And I'll be waiting for another pullback. It will pull back. This is way too high. Mexico borders are closed to cattle. We've got high tariffs on Brazilian cattle. But once the Mexico border reopens and they get this thing under control, you can expect cattle prices to fall. Mexico is one of the biggest exporters of beef, importers to us, and that will cause prices to fall. So keep an eye on this one. This one will be a fun one to watch. With that, hope you enjoyed this video. Happy trading. Let me know if you have any questions or comments. You want me to take a look at something in particular? Let me know. By the way, I will not be posting a video next week. It's going to be Christmas, so I will probably post a video after. Happy trading. Have a good one.